Hello, good evening. I'm Camilla Dolle. I'm responsible for the fixed income and credit research at XP. And tonight we're here to talk about the bond markets in our international week. So thank you all for joining. First of all, I would like to invite you all to connect to our Slido page so you can send us questions throughout the panel. And now I would like to invite our panelists to join us. So it's a pleasure to be here hosting both of you. So we have to talk to us about the bonds market and everything related to that. We have Tony Crescenzi. He's executive vice president and member of Pimco's investment committee. And also we have Mike Swell, who is head of global portfolio management at GSAM. So thank you both of you for joining us. Good evening.
Thank you, Camilla. It's great to be here with you and XP. Thanks for having us.
Thank you. I would like to first ask you both to introduce yourselves. So please, Tony, if you could start.
Thanks, Camilla. I've worked at Pimco since 2009. I've been on Wall Street since the 1980s, certainly a long time ago. I've worked at only 4 firms. One of them included Lehman Brothers, working in the World Trade Center on the 104th floor in the 1980s. So today I'm part of the investment committee at Pimco. We 9 members are charged with steering strategy for the firm's $2 trillion in assets, which include many of your valued assets, and we thank you for that relationship. Finally, I would say I'm a portfolio manager as well. I manage money in a global context.
Tony and I have an equal amount of experience, and I have a little bit more gray hair than he does. We were both at Lehman Brothers. I came a couple years after him, so that was one of the firms that I worked at, but I've been at Goldman Sachs for about 15 years, all within asset management. I am responsible for all portfolios across all different asset classes, and then have people on my team that oversee different portfolios. I spend a lot of my time personally on both global portfolios as well as multi-sector portfolios. And we manage about 1.3 trillion across different fixed income assets.
Perfect. So as you all can see, we have a great team here to talk to us about the bonds market and the global market, right? So to start here, our panel, I would like to turn to Tony to talk about inflation and rates. And I mean, recently there's been a lot of discussion targeted to President Biden's infrastructure package. And I would like to hear your view, Tony, about what are Pimco's views on the approval of this package and the general U.S. economy, and of course, over inflation and short and long-term rates, and also what, in your view, could be the side effects of these for EM markets.
Thanks, Camilla. This week, Pimco held a quarterly meeting where we devise our one-year outlook. And so we had a discussion on the fiscal outlook, and what we've come up with was something similar to the consensus, which is the idea that if there's infrastructure spending, the impact in the near term probably won't be all that great. What we're penciling in is $2 trillion of spending, but $1 trillion in tax increases, yielding, of course, a $1 trillion boost to the economy, but spread out over many years, 8 to 10 years. And it'll take time for it to take hold. In fact, what we would say about the fiscal story in the US and the developed markets more broadly, and this could influence the emerging markets and the performance, is that we're reaching a peak level for fiscal stimulus, and you'll see deceleration. So there may be divergence between the US developed markets and the emerging markets this year, with the developed markets outperforming, but we see a convergence next year as EM markets start to converge, in part due to improvements on the health story. Generally speaking, though, this should mean the growth story will be peaking as well, although growth in 2022, we think, in the developed markets will stay above what's considered normal, what's considered trend, above 2019 levels, but a major deceleration relative to this year. And this probably will mean a lower inflation rate. The peak, we think, is in the next few months in the developed markets, especially in the United States, and even in the emerging markets where there's been a jump as well, that may come down a bit. And speaking about the emerging markets, there are big so-called output gaps, meaning the difference between current output and potential output, which will probably keep downward pressure on inflation, which might be good for the local interest rate markets, including in Brazil, for example, as the inflation rates stay lower, because they had been falling until the recent bump up. And so generally speaking, we think it's a good outlook, but the infrastructure story probably won't change it much. And we're looking at peak growth, peak fiscal, and so therefore not a big worry on the inflation side.
And just on the peak inflation that you mentioned, what would be the peak in your view?
Well, it's difficult to say. In fact, one part of the discussion was the idea that forecasters, even the high end of forecasters, the major forecasters recently missed the year-over-year prints by a number of tenths of a point, which is a lot for the upper end of that target range, and so it's difficult to say and to pinpoint, but US CPI could move toward 3% in terms of core prices. The Federal Reserve would probably be happy with a figure close to somewhere in the high twos, because the CPI, Consumer Price Index, is not what it targets. It targets some other more technical index called the Personal Consumption Expenditures Deflator Index. It's just a broader measure of inflation. That tends to run, call it 0.3, 0.4 of a point below the CPI. So a CPI core, meaning minus food and energy, of high twos, be consistent with the Fed's hope that the inflation rate reaches the low twos on this so-called PCE, since it has a 2% target and wants it to run above that for a little while, meaning a couple of years perhaps, since it's been below that target for so long.
Thank you, Tony. And Mike, now turning to you. So as Tony mentioned, we have seen a lot of stimulus packages being announced, not only in the US, but also across the globe last year because of COVID mitigation trials, let's say. So, but on top of that, we have also seen a lot of companies and financial institutions issuing huge deals in the bond markets recently. And there certainly carries a leverage risk, right? So I would like to hear your views on this movement on the issuers, and also in your view, should we worry about it, or is it just part of the cycle?
Sure, I promise to get there, but your first question to Tony probably could take up the entire hour. We could have an entire discussion about that topic. I think that the most important factor that you guys both spoke about was inflation, not only where it peaks, but what is the expectations for inflation over the course of the next 1 to 2 years. That really drives a lot. Number one, we've had all these kind of supply chain issues, concern that inflation, the inability to be able to get workers to do jobs, that would have a big impact on corporate earnings. So that's a big concern in the equity market. And then I would also say it's a big concern in the bond and overall risk markets, credit markets, because the view is that inflation can be the factor that causes the party to end, the easy money, kind of the soft landing scenario. So I think number one, I think the most important point, and Tony said it very well with more detail than I'm going to say it, is that the idea that we are going to see inflation, whether it's in the US, whether it's in Europe, or whether it's in the emerging markets, really accelerate to the point where it becomes a problem, where it becomes something that central banks are going to want to mitigate. We think it's a relatively low probability. And most central bankers are looking through these kind of short-term issues. And as we look into next year, we're expecting inflation in a lot of different markets, plus or minus where central bank targets are. That is really kind of a Goldilocks scenario. It's a Goldilocks scenario in that a lot of people are getting back to work. Output gaps over the course of the next few years are going to move towards getting closed, but it's not so rapid that it's going to cause central bankers to significantly make changes over the course of the next year. And what does that mean? That means that risk assets still look pretty good. And the fear that everybody had about bonds, that, you know, short bonds at 1%, 1.5%, 2%, the party's over. I think a lot of people that have done that are going to potentially regret it. As we continue to have a low vol environment, bonds are going to be an important ballast for portfolios, still providing a decent amount of hedge efficacy for risk assets. And then if you think about the credit markets, now the credit markets have seen this incredibly rapid recovery coming out of the COVID shock, but there are still areas of the credit markets that still offer very, very attractive spreads. It's not in the highest quality sector. So everybody initially in the COVID shock wanted to put balance sheet to work, wanted to buy the stuff that had the lowest probability of downgrade and default. So they went everything into the investment grade market, and they went into the US agency mortgage market. Well, those asset classes have gotten priced pretty unattractively now. So I would agree. I think that there's probably in those markets more risk than there is opportunity. But if you look at the gross sensitive assets, things like high yield, bank loans, commercial mortgage securities, you look at the emerging market spread markets, emerging market corporate credit, emerging market spreads, there is a lot of leverage to growth. And in the event that we see growth continue to improve in the way that we and Pimco both think is going to occur, you can actually see some pretty significant spread tightening there. So I know a lot of people are concerned, are we late in the credit cycle, the concern around leverage? Although leverage is higher, the bottom line is it's better leverage. It's better leverage in that rates are really low, debt service is low, and earnings are still very strong. So we are not overly concerned that we're moving at all anywhere towards the late end of the credit cycle. We would just move assets a little bit more from the higher quality assets that have gotten kind of priced out of attractiveness into more growth oriented asset like high yield bank loans and emerging market debt.
Great, Mike, thank you. I think this is very important because I think that many people, when they hear the word leverage, some dark times come to mind, but it's important to know that that's not really always the case, right? Now, Tony, I would like to ask you, I mean, you mentioned that you are a member of the Pimco's investment committee, so you certainly have a good amount of interaction with the global advisory board at Pimco. So I would like to ask you to please share what views they have and what do you hear they saying now about the main concerns and insights nowadays.
Thanks, Camilla. And to jump onto what Mike said, just real quick, we agree as well. The next 1 to 2 years are vitally important in terms of the inflation picture. There may be some transitory pressures on inflation, but they are just that. In fact, there are some upward pressures, though, that we're wondering about, though. And you could say some of these even relate to the ESG realm, which is an area our advisors have spoken to, which I'll get to. But if one thinks about it, there seems to be more willingness in the boardrooms of corporate America, for example, to increase wages for employees. So that's the S in ESG, the social side of the story. It does seem that businesses care more, if you will. There's a kinder, gentler boardroom out there that may mean wages rise a little bit faster, not rapid, just a little bit faster than they had, and a somewhat higher inflation rate, but not run away. And on the E side, the environment side, an area that we see our advisors speaking to a lot because policymakers care about the environment, even at the central bank level. There is also a willingness to accept higher costs to decarbonize, to reduce the carbon footprint in the world. Companies, major brands especially, are looking to do this. And so it will mean something. So advisors tell us, and this includes Ben Bernanke, former Fed chair, Mark Carney, who's big, so to speak, in the ESG realm. He's former head of the Bank of England, also the Bank of Canada. He sees a big effort worldwide, and certainly the incoming administration, the new administration, I should say, the Biden administration has made a lot of efforts and inroads already on the environmental front, and we expect more of that. And the EU, I should add, finally, it's clear, and Gordon Brown, former Prime Minister of England, another member of our board, he's spoken to this and looked at the EU Recovery Fund, and we all think it's pretty impressive in terms of the amount of money being spent. That $1 trillion effort, where a third of the money's loans and grants are put toward green initiatives. And so there is a worldwide effort in that regard. So those are some of the big issues, but I should add on the E side, on the central bank side, there is an effort amongst central banks, and we see this from the so-called Network for the Greening of the Financial System, a collection of central banks throughout the world, an effort to try to ensure that banks are safe from a climate change perspective, because banks make loans to companies that could get in trouble, so to speak, from transition risks and event risks that occur related to climate. So they're looking at that more, but it won't change the way they conduct monetary policy. It's more in the back end on the regulatory side. So there's a lot of things going on in the background. It's a big change, these 2020s from the 2010s, more activist role by central banks and fiscal policymakers. And so that's an important thing that could be good for growth in many ways.
Camilla, I would only add one point to that. And it's a little bit of an advertisement for firms like Pimco and Goldman Sachs, where I think we both would agree that these ESG factors are going to lead to greater and greater dispersion. And that's dispersion on the equity side, it's dispersion on the debt side. Cost of capital is going to become much more variable for companies on every single front, ESG, not only companies, but also countries as well. And so as we both kind of look at these different variables, they're variables that very much impact the way that we invest, not just to achieve ESG goals, but to generate alpha, and expecting that we'll see more and more dispersion and active management becomes a bigger factor.
Yeah, I'm very glad that you mentioned, both of you mentioned that, because there's still a misunderstanding about these factors, the ESG factors. People think that it's a trade-off between returns and being and investing in ESG related bonds and other kinds of assets, and it's not really right. We can achieve returns while investing in ESG products. So and also hearing both of you, right, who are part of such big players globally, talking about ESG is very important, especially here for a local market, because ESG is beginning to be more relevant here, and we have a long path ahead. We have been talking a lot about ESG recently here. We have an analysis appointed person just to talk about it, but we have a long road ahead. But it's nice to hear you talking about the relevance of that. So thank you.
Thank you, Camilla.
Now, Mike, I would like for you to talk a little bit about the exchange rates, and what's your view regarding the current valuation of the dollar in relation to both emerging markets and also other developed markets currencies, and is there any trend that you could point out given the current global scenario?
So I would say that, you know, we've in general, in a lot of different sub-asset classes across fixed income, we've seen convergence, we've seen narrow spreads, really very little differentiation. Currency is an area where there's still a decent amount of volatility and opportunities. In terms of directly your question on the dollar, we are pretty firmly in the dollar decline camp. We are of the view that you will continue to see easy monetary policy for an extended period of time, likely a steepening of the curve as inflation expectations change, but the Fed doesn't do anything about it. And then you have, whether it's $1 billion or $1 trillion, $2 trillion, whatever the case is, the debt load in the United States is growing at a pretty rapid pace that is likely to be dollar negative. So our view is that there are markets out there, in terms of particularly the short end, that offer an interest rate differential that is much more attractive and should be constructive for markets and currencies outside the U.S. We also do feel that we're going to be in a couple-year bull market for growth on the global basis, and it's not going to be just the U.S., it's going to be more on a global basis. And as a result, as you see that recovery spill into markets like the emerging markets as well, it should be pretty constructive. Now, we had a little conversation earlier in terms of before we started this call about what's the best way to play it, whether you play it in local rates, you play it in FX, or you play it in equities. We actually think there are a lot of emerging market currencies in particular that look attractive to the dollar. So that's one thing. That's a carry trade. That's a risk-on trade. That's a pro-growth trade, which we think, based on our view, makes a lot of sense. And there are obviously a lot of markets, like Mexico as an example, where real rates are very, very high, and so we find some attractive opportunities versus the dollar.
If I could add, if I had a list, Mike, of the reasons we would be negative on the dollar, with not high conviction, but we're somewhat bearish, I would have used everything you said. So what I'd add to that is on our expression would be in what I think you're alluding to is in EMFX and also commodity currencies, which look good to us. Brazilian real, for example, the Russian ruble, Colombia, a few others, South Africa, in fact, as well on the rate side too. So we would just add to that.
Thank you. Tony, if I could jump on to you. So I would like to hear your view on the Fed's tapering its asset purchases sooner than expected. And what do you think could be the main consequences of such an event, and how different would it be from the 2013 taper tantrum? I think it's a lot really related to the inflation question here, but could you talk a little bit about that?
Yes, we have a view that's similar to what the market has as a view, which is instructive in itself in terms of the future market response, we think, but not necessarily, because markets are prepared, and it's different than 2013. It seemed that Ben Bernanke's comments in the spring took some by surprise. He often alludes to that. He thinks perhaps it was a communication issue, and he says in a book he wrote that monetary policy is 2% action and 98% communication. So words can matter a lot. So the central bank has learned a big lesson. The current leadership understands this. I know my former colleague, Rich Clarida, who's the current vice chair of the Fed, understands that. So certainly Chair Powell does as well. Bernanke in meetings with us has said that the reaction, he can't, of course, judge how markets will respond, but he thinks that the response from his vantage point to the Fed announcing a taper would not be as great. For one, he thinks the communications would be better. He thinks there's more unison on the Fed today than there was in 2013, which will enable clearer communication about the plan than he was able to give, because there was some division at the Fed in 2013. And again, as I said, markets already on this side of thinking that there'll be a tapering. And there's been a yield adjustment. Yields have moved up meaningfully in the US, even though they're not high. They did reach as high as 3% for the US 10-year back then. It's still far below that, but the base rate is different now. And the expectation is a lot different. Back in 2013, there was a belief priced into markets that the Fed would eventually raise its policy rate to above 4%. That view doesn't exist today, and interest rate forwards and various ways we could look at this, it shows the market thinks it'll be in the twos, low twos, and it's already priced for it, in other words. So it's not likely to take markets by surprise. So in terms of timeline, we expect an announcement, call it December of this year, for tapering, meaning a reduction in the Fed's current $120 billion per month in bond buying, 80 billion of US treasuries and 40 billion of mortgages. It may be implemented that month, December, or begin January of 2022, ending the tapering, meaning stopping its bond buying by the end of 2022, and then allow 6 months at least, and Bernanke has said this to us as well, because the Fed promised to leave some time between the end of tapering, meaning the end of 22, and the first hike, which puts the hike timeline somewhere in the second half of 2023. So we don't think the Fed will want to repeat what happened in 2013 and surprise markets. Will be very careful with its words, which are most importantly, and also of course its actions in the end will matter too. So we're not looking for a significant reaction in the emerging markets. As I said earlier, the inflation story is better. The output gaps are wide, so the pressure on rates probably won't be significant to the upside. They shouldn't be. And also there's the surprise factor removed. And finally, more important to the emerging markets next year probably will be politics and not the Fed.
And one point to add about tapering, I think the question that we all ask is that if we assume that that is the timeline, are there different markets or asset classes that are not priced for that timeline? And agency mortgage-backed securities, which may not mean an enormous amount to people in Brazil, unless you are invested in a core or global ag portfolio. In a global aggregate portfolio or U.S. aggregate portfolio, it's a very significant portion of the benchmarks that we manage against, as much as 35% here in the U.S. It is a very, very unattractive asset class right now because of the purchasing by the Fed, purchasing by banks has kind of driven that asset class to something that looks worse than treasuries. And so what we do in terms from an active standpoint is we try to own as little to none of those securities. And I think those securities have not priced in the path that Tony laid out. And so as a result, once we start talking more and more about tapering, that's an asset class that will very significantly reprice as it has to bring in marginal buyers when the Fed no longer is that marginal buyer or the dominant buyer.
We agree, Mike, and we've been reducing our agency MBS holdings. Our own models show mortgages to be rather expensive. The one caveat we might have is that supply of mortgages next year might be a bit less, so that could help alleviate some of the strain in markets, and the amount of refinancing on higher coupons into lower coupons will be lower, which is, again, will have an impact on supply as well. So there may be a supply factor to help. And finally, the so-called carry, the interest story will improve a little bit because of the lack of refinancing if rates went up, if mortgage rates went up, because the holder would, of course, be able to reap some of that. But we agree in general about that being an important area of indices that we're not as allured by as they were when they were cheap and the Fed was buying them. So that'll be helpful. One final note, though, for those who care, what the Fed decides to do after 2022 will matter with respect to mortgages and the reinvestment of the principal and interest payments that it gets. And that's something to be following closely next year.
Thank you. And now talking a little bit more on emerging markets and Brazil, Mike, I would like to hear in terms of your portfolio positioning and also, of course, given your expertise, what are your current views on emerging markets, and specifically if you have any points related to Brazil, Brazil's risks and opportunities in the short to medium term, and how could bond investors take advantage of that?
So we think that Brazil right now, given the continued challenges from a COVID perspective and kind of the challenges that has on the economy, some of the kind of political issues that exist in Brazil have created a lot of value in assets in Brazil. We view the most attractive opportunity is in some of the credit markets where you've seen corporate credit in Brazil kind of lag both emerging markets and clearly lag the developed markets. And so we find the market to be very attractive. We always like the inflation-linked securities in Brazil. They're a very illiquid asset, the government security, but kind of very much underpriced kind of inflation risk in Brazil. So I would say the combination of dollar corporates in Brazil plus kind of local inflation protection we think is attractive. But more importantly, more broadly, the emerging markets from a credit perspective are one of the few markets that really has not seen the recovery bid, the liquidity bid, and it really sits out there as an asset class that is pricing in a very prolonged slowdown, very prolonged concerns around COVID. And even though things are worse in Latin America than they are more globally, help is on the way. And so when you see kind of improvements elsewhere, you see some improvements in emerging markets, it's going to happen in Brazil and Latin America as well. We've seen some stabilization in some of the political concerns around Latin America. And if you believe in growth in the US and you believe in growth in China, the emerging markets will follow. And you see a pretty elevated risk premium there. So we actually think that it's a pretty attractive opportunity. We rarely in US portfolios will make a beta decision to go into emerging markets. We might decide we like Petrobras bonds or these bonds or those bonds, and we'll buy some here or there. But it's rare that we'll make a big kind of asset shift out of, you know, U.S. investment grade, which is a gazillion, you know, dollar market, and go into the emerging markets. We're doing that now because of the lag and the confidence we have in global growth, and that we think that we'll see spread tightening in those markets. So we think it's a pretty attractive opportunity.
I would add, Mike, we tend to agree, and we think the most liquid expression for larger players, of course, is in currencies. I would add on Brazil, short local rates look good to us, decent, looking out to 2024 maturities, given the amount of rate hikes that are priced in.
Thank you, Tony and Mike. And now Tony's still on EM, but switching a little bit gears to politics. How does Pimco foresee the US and China tensions under Biden's administration? And given the relevance, of course, of China's economy, what could we expect as an outcome for the global markets of course, your view on that?
Okay. Well, first, we had a poll, in fact, just by coincidence, at our forum, and most think, although the poll doesn't tell us a lot necessarily because it's from people around the world. I'll tell you what our Asia offices think more importantly. But the poll, in the internal poll, it said that most of us think that, to sum up, that the tensions will be more on a simmer than a boil, meaning they won't get a lot. They won't cool off much. The tensions, they won't get hotter. They won't boil. They kind of stay where they are. That's generally where we are. And our offices in Asia tend to agree with that. We're not looking for any major policy shifts by either side. No lifting of tariffs, for example. In the end, though, what we've got to worry about, and this is something from Gordon Brown, the former prime minister. He had a conversation a few years back that I haven't forgotten, that I thought was important in terms of framing thoughts on China. He said that Xi Jinping, the president of China, said to him, what China wishes to avoid is first, the middle income trap, where a nation is ascending and it kind of gets stuck at a certain income level and doesn't really grow to become a developed nation. And then secondly, relevant to this discussion is the Thucydides trap, named after a Greek historian from the year 400 BC, who spoke to the idea of a rising power threatening an existing power and causing tension or war. And in fact, that has happened often throughout history, although we wouldn't bring it to that point. But it certainly has been tension, and we may be in that trap because it does seem that these tensions may go on, but they may be different than the tensions that existed between the US and the Soviet Union, for example, the Eastern Bloc during the Cold War, which of course lasted until around 1990. That was more a battle over, you could say, military might, and it's a different type of global presence. Here it's more economic, trying to dominate in different parts of economies, supply chains, for example, perhaps manufacturing, and moving up in China's case in terms of what they make, wanting to make more high quality products and also integrate into the global financial system. What I'm trying to say is that the competition can be a good thing. And I would refer back quickly to the Cold War story. If you went into a cave because you're worried about Cold War tensions from the 1940s till 1990, you lost. It didn't help you. Similarly, it hasn't helped you to be worried about the US-China relationship in terms of having exposure to equities, to credit, and to private assets. It was better to invest than to stay away because you were worried. In fact, the pie more likely grows because of the competition between the US and China on various fronts, including with respect to technology and climate. It may mean, for example, the US is far behind in solar. Maybe we'll do something about that. But I wouldn't say, I don't know much about that area to comment, but the competition can be a good thing, could be good for investors. So expect tensions to stay high, but don't let that get in the way of investment decisions.
I don't know, Mike, if you want to add something.
Oh, I always want to add things.
So please do.
I would agree with that assessment. What we try to do at GSAM is really think about kind of the left side of the T ledger versus the right side of the T ledger. What matters, what doesn't matter. And geopolitical risk can always drive you crazy. And it could always say, get out, get out. And I think what you really want to think about is how do these factors impact growth on either side, composition of growth, how do we think about competition across different markets? And I think and when you think about it that way, there are things with regard to tension and trade with China that does impact your investing. Obviously, we invest on your behalf, on your client's behalf in the emerging market, corporate market. China is a very large portion of that. And how you think about lending to Chinese companies when their geopolitical tensions are potentially very high. You look at the Huarong situation recently. How does China decide to deal with dollar investors in that case? And so these are factors that we think about, but much more kind of from a bottom-up perspective than on a big macro perspective.
Thank you, Mike. And still with you, Mike, talking a little bit about the European recovery. So the EU has recently approved a big recovery package, about $800 billion after the impact from COVID over the country's economy. So could you please tell us a little bit about your view on the package's potential and what it could mean to the zone's companies? And also, have you already seen any kind of impact over European bonds since the approval?
So Tony made comments earlier about the green portion of the package and the impact obviously on certain countries and certain companies that are very correlated to that and are going to gain access to funding. I think that Europe is going to be in what I call the Goldilocks scenario for a much longer period of time than the US. Europe still has an output gap that will not go away in our very short-term investment lifetime, and still has massive struggles between a strong and buoyant northern economy environment versus kind of the southern challenges that exist in countries like Spain and Italy and Portugal. Those kind of divergent issues will continue to drag on Europe overall. And you do have kind of an output gap in some of those countries that is not going to be erased by short-term fiscal policy and has not been erased by negative rates. So we are of the view kind of you're going to see very modest, slow level of recovery. Not a horrible thing, particularly for the credit markets in Europe. Not a bad thing for financial institutions debt. We actually like some of the subordinated debt. The COCOs that exist in Europe, they're offering very attractive yields. And as long as you see growth that's good enough, you should see actually pretty good performance of the credit markets in Europe. But we are in general of the view that rates stay low in Europe for an extended period of time, vol stays low, and the ECB is the dominant buyer of everything and still provides support for the foreseeable future. So that doesn't mean that you can't make money. You can make money in the credit markets in Europe. You can make money even at negative rates. You can make money on longer parts of the curve in Europe. And then I think there are opportunities still in the equity markets. If you do have this kind of Goldilocks scenario, rates stay low for an extended period of time. It may not be very good for the banks from an earnings perspective, but growth should be good enough, and you have a pretty cheap equity market in Europe. So some opportunity there, but in general, slow, steady recovery, extended period of time. Would not expect any sort of massive green shoots out of Europe.
If I could add, Camilla, I would augment all of those comments. I agree with literally everything Mike said. On the green part of the recovery bill, if you want to call it that, not much of the money will flow through to Europe because a lot of the green technology is not owned by Europe, so to speak. It's owned by America and Asia. So, for example, when Europe looks to add, I think it's 500,000 plus electric vehicle charging stations, it needs semiconductors, and of course, it doesn't produce any of that. And the companies that do benefit are in the United States and in Asia. And so one does have to, as Mike suggested, look at it from the bottoms up and find the companies that benefit. I should add, finally, Mike, we like COCOs as well. AT1s, banks in Europe. Think about this story, COVID story. No banks were in trouble. Banks were looked at much differently this time versus 2008. They were looked at as villains then. Here, more of the heroes helping the story out to improve. So no one's going after the banks, and banks perform very well. So this is an asset class yields that are something like the high yield bond market with volatility like it as well, but certainly not the default angle. High yield bond market can have a much higher default rate. We're not seeing any of that in the banking systems.
And European banks are not allowed to get in trouble anymore. They've been, regulated to the degree where it's very hard to cause a lot.
They're well capitalized, absolutely.
Yeah. Great, thank you. Just before we move towards the end of our session, I will take a question from the public. So they have a question for both of you, and it's: during your whole professional life, long-term dollar yield trend has always been down. So how do we invest in bonds moving forward? It's more of a straightforward question, but if you could, I think it's basically a summary of everything we've talked about. So I'll direct it first to Tony and then to Mike, please.
Okay, Mike said it earlier and quickly referenced it, the idea that there's still hedge value in high quality securities. And so when one thinks about the yield and its destination, we shouldn't be as interested in that pinpoint precise forecast as to where the yield goes. We should be interested as investors in prudent portfolio construction. So we would prefer at Pimco, for example, many investors would, to be overweight equities globally, to be overweight credit instruments, to be overweight investments in the private markets of various sorts. But what will we put in our portfolio for diversification, for protection? Because there still is likely hedge value in high quality securities such as US Treasuries, not the agency mortgages we were speaking about earlier, which we think don't have value. But we do think for protection, to get in the car and drive, got to have, we hate to use this word in the investment industry, insurance, but you need something to protect against tail risk, the left side, as Mike put it earlier. And so one has to be thinking about that. So yields have been in a downward path for 40 years. We're not thinking that it's likely in a lengthy period of an upward path. There's still factors that will keep it in a downward path, or at least downward pressure. Think in Japan, population today, 125 million. By 2050, it's expected to be under 100 million, which means slower growth for a long time and probably low interest rates. In the US, the labor force has grown at about 0.5% per year the past 10 years, half the rate of the previous 10 years. And projections are by nonpartisan groups, including the Congressional Budget Office, for it to grow 0.4% the next 30 years, meaning slow growth in that component. Add that to productivity gains, which are running about 1.5%, 1.5 plus the half, that's 2% growth potential. Typically, interest rates are low in that context. It's possible productivity increases, and typically with that, over time, just because of competition for capital, there could be somewhat higher interest rates, but we're not looking for that. So again, the bottom line for investors is to be thinking about what else is in his or her, its portfolio in terms of companies, seek to be taking risks in the climate where there's strong growth prospects, and it looks like that's the case through at least 2023. But look for some protection and expect rates to move up perhaps, but not a lot. And as Mike said, there's some hidden carry in some securities, including in German securities, which are low or negative yielding because there's something magical, as we would call it, called roll down, meaning as security ages in a steep yield curve, the yield goes down because a 5-year yields more than a 4-year. As a yield goes down in bond land, that means a higher price. And so there's already a little bit of a cushion for investors against rising yields through this so-called roll down. And so think of everything in a portfolio context.
Well, I would add 2 points. One, your question is actually a very good one. You're like, rates are low, but you say that they have hedge efficacy. So I get that. But then on top of that, you're saying the dollar is bad. And so why would I want a low yielding asset with a currency that I think is going to do poorly? And I think the point is really around, you actually are more leveraged to an asset class that actually has hedge benefits and balance in your portfolio. So I would say that in the event that the world goes bad, it's still treasuries and the dollar that rule in that scenario. And so you get the double benefit. And then I would say the last point, and it's back to kind of the commercial and around maybe some of the emerging market corporates, where you kind of get the best of kind of all the worlds we're talking about. You have exposure, obviously, when you buy an emerging market dollar fund, you have exposure both to a spread, and we think that emerging market credit spreads are attractive. So we think that's a good buy. And with growth improving, we think you'll see credit spreads tighten, but you have a lot of cushion there because you're getting that spread that you may not be getting in treasuries. But then again, in the event that the world does go bad, that is a US security backed by treasuries and backed by the US dollar. And you should actually, that portion of a EM corporate portfolio should actually do very well. And so you're getting some of the exposure there.
And Mike, and also another aspect of this idea of owning treasuries, for example, from the Japanese perspective, it's one example, the hedge costs of if they're worried about the falling dollar, they can hedge it. So they can sell the yen, buy dollars, but sell it, hedge it. The hedge costs have gone down. And so the treasury yields look quite attractive to the Japan-based investor today. And so they don't have to worry so much if they hedge the currency worldwide. The hedging against dollar losses is the cost has gone down a lot.
Thank you. And so we're actually now moving towards the end of our session. So I would like to hear both of you on the lessons learned last year. I mean, in the last 12 to 15 months during the COVID crisis, which was very emblematic. So what would be, in your view, the main lessons learned, and how does it how are they different from other challenging times that you've been through throughout your careers?
Well, maybe I'll kick off first.
Sure.
First off, I would say that I learned that with each additional financial crisis that occurs, my hair gets even more gray. And so like it's like an exponential factor. It's not a linear factor. I would say we have learned to understand central bank reaction functions a lot better. Tony talked about communication from central bankers. It is better, it is critical, it's very well thought out. And so as a result, when prior to COVID, nobody predicted COVID, there might be investors out there that say it, but they didn't. We thought a lot about, under different scenarios, how would central banks act? And so it enabled us to be a lot quicker to market. So we learned to be faster. How do we learn to be faster? One is you want to be prepared in the event that there is an event on how you're going to behave. Number one, you do not own risk assets for the sake of risk assets when they're not very attractive. So being in a position where you have dry powder, you have risk capacity if assets are not overly attractive, very, very important to be able to react to a crisis. Secondly is you never want to act because you're fearful the world is ending when a crisis occurs. You have to have a plan. The plan is devised by reaction function of governments and reaction function of central banks. And we were very confident in the way that central banks had acted, not only in the previous financial crisis where they recognized they got it wrong, they were too slow, and it took many, many, many years until recovery occurred, that you have to act quickly and you have to act with vigor to make a difference. And then we had a number of different financial market issues that occurred post the other financial crisis, funding issues that occurred where the Fed stepped in very quickly to solve them. Commercial paper problems, when there was a change in the commercial paper market or in the money markets in the US, central bank came in big and said, we will not let the pipes fail. And so our view is that you want it to be in a position to act. You need to have technology on your side. You need to be ready to act. You need to be able to use technology to act more quickly in the marketplace, very different than we were able to do in the previous financial crisis. And as a result of that, we were able to add a lot of risk during this crisis and be very confident that you would see very, very significant action from governments as well as central banks to avoid turning a financial crisis into an economic crisis.
Well, good points, Mike. And we would agree with, I'd say, all of them. And I add on a few other things. I mean, especially your point about the reaction function being understood better. I alluded to it earlier by looking at the forwards from 2013 and how markets were priced for the Fed to eventually raise its policy rate to close to 5%, in fact, for a short time. Never got there, never got even close. And so that understanding about what central banks are likely to do, and also this belief that interest rates are likely to stay low for various reasons like demographics and low productivity and slow credit growth, are more well understood and appreciated and embraced, in fact, by markets. Another lesson, though, I've learned, I wrote about this in my recent book, is the idea of, and if I didn't mention, I've published 6 books and 1 published this year, 500 pages on the bond market. The idea of chaos at the end of cycles. We saw it in 2008 and 2020. The cycles ended chaotically with spreads in credit instruments that were much wider than the default likelihood, at least in terms of the realized defaults. Who knows? I mean, during that period, who knows, maybe it was the right view that defaults could go higher. Central banks did come in and save the day. But the point I'll make about chaos is related to how to position today to have a portfolio that's a little bit more liquid, a little bit more flexible, a little bit more agile, have a little bit of a cushion, because there will be opportunities when there's volatility. And what I'm suggesting is it's almost inevitable that when this credit cycle ends, meaning when recessions are around the corner, that there will be a sharp widening of credit spreads. Why? Because of something we call the principal agent model, set up by, you could say, the Fed. This idea that the principals, sellers, need go to somebody, an intermediary, to sell securities, buy and sell securities. But the regulators have made it difficult for intermediaries to want to hold inventory, to be able to hold inventory of bonds. And there are lots more bonds in the world today than there ever was because of huge issuance by companies, huge issuance by governments. And so who is it that will take the other side of a trade when there's stress? That ability to handle the amount of debt securities that exists is lower. And so in a period of stress, credit spreads will go wider than they would otherwise go based on the actual default probability and chances. So for example, a triple B rated US corporate security dating back, I don't know, 50 to 70 years might have a default rate of 0.6%, meaning you have 99.4 at a worst case. And this was 2008. You have a 99.4% chance of getting your money back. Typically, I think it's a 0.1% default rate on a triple B rated security historically. But again, it jumped to about 0.6, I think, 2008, 2009. So, but yet there's those securities, and there's a large amount of triple B rated securities in the US corporate bond market. It's the biggest area of issuance. They traded terribly, as if the default rate would jump meaningfully. And again, it relates to technical factors, not fundamental ones. So a key lesson is to have some dry powder for those opportunities, because there are some decent companies that are not likely to default on you. You get your money back, and that's what a bond investor cares about. Finally, 2 quick things. ESG, people care more. My generation perhaps cares less. The youngest generation cares more about it. I certainly do personally. I always have. I grew up on what's called Staten Island, New York, which had the largest garbage dump in the world until it was closed about 20 years ago. It's the largest thing made by man because it was 50 years of New York's garbage. So I cared about the issue in the 70s. The world seems to care about it a lot. And it's going to mean a movement of money into different areas, different industries, because of ESG related factors. So I'll be thinking about that. And finally, this is more personal, I'd say. I understand more the difficulties of balancing work and home. if there are people around me, and I'm in a home right now, it doesn't look like it, but I am. It's difficult. I need to isolate myself. I find it difficult. So for anyone who's ever had to stay home and juggle work with family, boy, do I appreciate it more than ever. It is very, very difficult to do that. And I don't want to say I can't wait to get back to the office. I'm going in tomorrow, in fact, but in some ways I find that easier. So it's a difficult thing, and I have greater appreciation for the amazing skill that so many pull off, and generally that's women.
Camilla, two things quickly to add. First of all, Tony, I agree with your three things. One, I agree with your point about staying at home and the challenges there, and how much more respect we have for people, whether man or women, do that. Really amazing. Secondly, Staten Island, Royal Crown Bakery. That place is sick.
You know.
By the way, we drive an hour each way to get there just to get it cookie, and amazing place. And then lastly, to relate the two last questions that were asked, I think that one other point is around your question earlier around why buy low rates and why buy a dollar that you think is going to weaken. One of the things that we do in portfolios, even though we don't love duration necessarily, and U.S. market's okay, we actually usually carry an overweight to duration to create ballast in portfolios. And that was a meaningful factor for us, particularly back in February and March of last year, that put us in a position, even though some of our credit spreads widened out to levels that Tony had mentioned, we still were in a position because we had rates that rallied meaningfully that enabled us to be front-footed instead of reducing risk.
Great points, Mike, especially about Royal Crown.
That place, if anyone comes from Brazil to
there's
America,
a long line to get in,
great.
Perfect, thank you for the tip. So, well, I think this concludes our panel. I would like to thank you so much for joining us and for all the insights you have given us. It's been a pleasure to be hosting here. I'm sure our viewers found it very insightful as well. So thank you so much for being here with us today, Mike and Tony.
Thank you, Camilla. Thank you to you for tremendous discussion, and for this great opportunity to be with you and to have the trust in you. I wish I could say it. They told me to speak, but it looks like I can't use my Portuguese too well. I can't even find my note because I'm just gonna. I know I'd fumble it. I want to say thank you. I'll say it in English.
Thank you.
Thank you, Mike. And for all of you who are watching this, please answer our survey. I think the QR code is here. And so leave us your feedbacks and any kind of suggestions and comments you might have. So thank you all so much. Bye-bye.